We all know Warren Buffett. He's probably the most famous investor on the planet, but have you ever stopped to think, who taught him? Who gave him the playbook for his entire empire? Well, the answer is the man who literally wrote the book on modern investing.
And there you have it, straight from the man himself. That's not just some nice compliment. It's an endorsement that basically cemented a legend. The man behind that book is Benjamin Graham, and honestly, it's hard to overstate just how much he shaped the world of finance. To really get how he came up with it all, we've got to go right back to the beginning.
So Graham's story, it doesn't kick off on Wall Street like you might think. Nope. It starts with some real hardship, a whole lot of brain power, and one big decision that changed, well, everything.
He was born in London, but his family made the big move to New York when he was just a year old. But things got tough, really tough. After his father passed away, the family plunged into poverty. So from a young age, Graham learned the value of a dollar the hard way. But man, was he smart. He just blazed through his education.
Okay, now get this, because this is where his story takes a major turn. He graduates from Columbia when he's just 20 years old, second in his whole class, and he gets offered teaching jobs in English, Greek, and math. But Graham, he saw a completely different path. He said no to the quiet life of a professor and yes to the total, utter chaos of Wall Street.
And on Wall Street, that incredible mind of his was about to get tested in a way that I don't think anyone could have ever imagined. He was headed straight for one of the biggest financial disasters in history.
This right here, this is the big question of his entire career. By 1929, Graham was already a rising star. And then, the market just fell off a cliff. The Great Depression began. This was a moment that could have shattered him. But it didn't. It made him who he was.
So while countless other investors were getting absolutely wiped out, losing everything, Graham's fund only lost 20%. Now, in the middle of that kind of financial carnage, a 20% loss isn't a failure. It's a masterclass in how to survive. He didn't see it as a loss. He saw it as the most important lesson he would ever learn.
So yeah, this trial by fire, it gave him a mission. He saw that the old ways of just guessing and following the herd were a surefire way to go broke. He decided to dedicate his life to building a fortress of logic and discipline to protect investors from their own worst enemy, their emotions.
So out of the rubble of the Great Depression, Graham basically builds this whole new philosophy, the one we now call value investing. Let's break down the core rules, shall we?
This brings us to his absolute golden rule, the margin of safety. The idea is actually pretty simple, but it is so powerful. First, you do your homework. You figure out what a business is actually worth, its real, intrinsic value. You look at its earnings, its assets, everything. Then, you wait, and you only buy its stock when the market offers it to you at a huge discount. That gap, that's your margin of safety. It's your buffer against bad luck, mistakes, and a crazy market.
To really drive the point home on how you should act in the market, Graham came up with this brilliant analogy. He invented a character he called Mr. Market. Imagine Mr. Market is your business partner and he's totally unhinged. Some days he's ecstatic and offers you sky-high prices for your shares. Other days, he's terrified and will practically give them away for pennies. Graham's point? His mood is not your problem. You don't have to listen to him. In fact, you should use his wild mood swings to your advantage. And this all feeds into a really sharp line Graham drew in the sand between investing and speculating. For him, investing was like being a detective. It was all about careful analysis of a business's true value. Speculating? That was just guessing, following fads, and hoping for the best. His number one priority was always managing risk and avoiding losing your money, period.
He didn't just keep these ideas to himself. He wrote them all down for us. Security analysis, that's the heavy-duty textbook for the pros. The Bible of Wall Street, really. But The Intelligent Investor, that was his gift to the rest of us. He took all that deep wisdom and made it accessible and practical for everyday people.
Okay, so the ideas sound great, right? But did they actually work? Oh yeah, the proof, as they say, is in the pudding, and in the incredible success stories of the people who followed his lead.
Just look at these numbers. For 2 decades, I'm talking through a world war, through recessions, all of it, Graham's fund was pulling in an average return of around 20% a year. This wasn't just luck. This was a system that worked, and it consistently crushed the market averages.
And if you want a perfect example of this in action, you have got to hear the story of Geico. In 1948, his fund bought half of this little insurance company nobody really knew. An investor who had about $11,000 worth of a stake in that deal saw it balloon into more than $1.5 million. I mean, talk about a value investing home run.
But Graham wasn't just making money, he was making disciples. As a professor at Columbia, he taught and mentored a whole group of students who later got nicknamed the super investors. And his star pupil, of course, was a young guy from Omaha named Warren Buffett, who said Graham was one of the most influential people in his entire life.
So why are we still talking about a guy who passed away back in 1976? It's simple, really, because his core ideas are absolutely timeless.
His wisdom is just as crucial in today's crazy high-speed market as it was back in the 1950s. I mean, think about it. Treat a stock not as a blinking symbol on a screen, but as owning a piece of a real business. Always, always demand that margin of safety for protection. Do your own research. And learn to ignore Mr. Market's daily trauma. This isn't just old-school advice. It's the bedrock of intelligent investing.
Now look, no strategy is perfect, right? And Graham's is no different. Critics today will point out that his laser focus on tangible assets, things like factories and inventory, can cause you to completely miss out on today's huge growth companies. How do you measure the book value of a company whose biggest assets are software code or its brand? These things don't always show up on a balance sheet. In fact, even Buffett himself evolved Graham's ideas over time to pay more attention to a company's quality and its potential for growth.
But in the end, you can boil Graham's entire life's work down to his two famous, simple rules. His philosophy isn't really about chasing the biggest, fastest returns. It's about the slow, steady, disciplined job of protecting and growing your money. It's a way of thinking that was forged in the fire of the Great Depression, and it's one that still guides the very best in the business today. So the next time you're thinking about buying a stock, just remember the master's simple, powerful rules.